stop. Do not buy a single ounce of silver this February until you hear exactly what I'm about to say. I am deadly serious. If you click away right now, or if you skip ahead thinking you already know what happened in January 2026, you are about to make the most expensive mistake of your investing life. We didn't just witness a market correction. We witnessed a crime scene. In a mere 31 days, silver accelerated 70% to a historic peak of $121, only to drive off a cliff and vaporize 30% of its value in the final 48 hours. The financial history books will call this Silver Thursday 2.0, but the survivors, the professionals like us, will call it the purge. Do you want to know if you should catch the falling knife at $85 or wait for $75? Is the bull market dead? To answer that, you need to know who set the trap. You need to see the smoking gun. This was not random. This was engineered. A play directed by Beijing, agitated by Washington, and executed by Wall Street. And today, I'm going to dissect this case layer by layer, so you don't become the next victim. Welcome back. Buckle up, because we are heading straight into the eye of the storm. To understand why millions of investor accounts evaporated at the end of January, we can just look at a price chart. We have to view this as an action movie with 3 distinct acts. If you don't know which act you're standing in, you are just exit liquidity for someone else. Act 1. The squeeze. January 1st, January 20th. Everything started when 2026 knocked on the door. Silver opened at a modest $71. But beneath the calm surface, violent undercurrents were churning. On January 1st, China, the factory of the world, officially activated supply weaponization. They reclassified silver from a standard commodity to a strategic material, placing it on the same tier as rare earths. Why? Because Beijing didn't want a single gram of silver leaving the country when they needed it for solar panels and EVs to fight American tariffs. Immediately, the COMEX vaults in New York were gutted. 33 million ounces of silver vanished from inventory in just the first 7 days. Imagine that. 26% of registered inventory evaporated in a week. At this stage, fundamentals were still king. Price rose because of genuine scarcity. Act 2. The euphoria. January 21st, January 29th. This is when reason left the building. As silver broke $90, President Trump took the stage. On January 27th, when asked about the weakening dollar, he replied nonchalantly, "No, I think it's great. The value of the currency is doing great." The market translated that sentence as, "The president wants to devalue the currency. Buy every hard asset in sight." The retail crowd rushed in like moths to a flame. The silver ETF SLV saw record inflows of $171 million in a single day. Silver tore through every resistance level, shooting straight to $121 on the morning of January 29th. Everyone was screaming $150, maybe even $200. They were drunk on victory, missing the Grim Reaper looming right above them. Act 3. The slaughter. January 30th and 31st, and then the trap snapped shut. Not 1, but 3 consecutive punches to the face of the bulls. First, Trump nominated Kevin Warsh as Fed chairman, a man notoriously hawkish, signaling the end of the cheap money era. Second, Microsoft crashed due to massive AI costs, triggering a wave of margin calls across the entire market. Third, the CME exchange raised margin requirements by 18%. Overnight, the result? Silver went into freefall from $121 to $84, a 31% collapse in less than 48 hours. Anyone who borrowed money to buy the top was completely wiped out. Now, let's go deep. Why do I say this was an engineered crime? Look at the fingerprints of the big players. China and the geopolitical chessboard. Don't be naive thinking China tightened silver exports just because they were running low. No, this was retaliation in the US-China trade war. China controls 60–70% of global silver refining capacity. When the US sanctioned chips, China responded by choking off the raw materials for the West's green energy sector. The interesting part: the premium in Shanghai skyrocketed to $14 above the world price. This broke the arbitrage mechanism. Usually, traders buy cheap silver in London and sell it high in Shanghai to balance the price. But with export bans and logistics gridlock, That flow was blocked. Beijing created a separate price island, and the rest of the world panicked due to a physical supply shortage. They weaponized the periodic table, and silver ag was just the latest bullet. Trump's weak dollar trap and the Kevin Warsh U-turn. Here we see the cruelty of American politics. On January 27, Trump said he loves a weak dollar, herding the sheep into the risk asset pen. But just 48 hours later, he nominates Kevin Warsh, a man who hates inflation and supports a strong dollar, to replace Jerome Powell. Do you see the contradiction? There is none. Trump is a traitor. He hyped the market to create economic euphoria, then appointed a tough sheriff to clean up inflation before it spiraled. Kevin Warsh taking power means, don't dream of rate cuts anymore. And when real rates rise, gold and silver, assets that yield zero interest, are the first to be sold. Speculators were caught offside by Trump, and it hurt. See, the Microsoft domino effect. When AI bites back, this is the point many pure silver investors missed. Why did Microsoft's earnings crash the price of silver? The connection lies in the margin call. Hedge funds on Wall Street were playing both sides. They were long on AI tech stocks and long on silver. When Microsoft reported that AI costs were eating into profits, tech stocks tanked. To save their losing stock positions, these funds were forced to sell whatever was profitable to post cash collateral. And what was the most profitable thing at that moment? Silver, which had just pumped 70%. Silver wasn't sold because it was bad. It was sold because it was the fattest pig in the portfolio, ready for slaughter. Add in the CME raising margins by 18% at 6 p.m. on January 29th, and the longs were backed into a corner. Post an extra $15,000 per contract or get liquidated. Most chose, or were forced to liquidate. And, boom. Rajkot, India, the graveyard of short sellers. We talk a lot about those who bought the top, but this crash was brutal because it killed the short sellers too. In Rajkot, India's silver trading hub, 44 major firms declared bankruptcy in 48 hours. Estimated damage, $1.2 billion. Why? Because they shorted silver at $75 and $80, thinking it would correct. They never expected $121. The gap between their sell price and the market price blew up their entire capital. They died before the price crashed. This proves a brutal truth. The market can remain irrational longer than you can remain solvent. The shorts died on the way up, the longs died on the way down. The house took it all. So now that the blood has been spilled, what do we do in February 2026? Look at the historical data. It doesn't lie. February is the death zone for silver. In the last 10 years, silver has dropped in February 80% of the time. Why? Because China goes on Lunar New Year holiday. The Shanghai Exchange closes from February 16th to 23rd, when the world's biggest buyer goes on vacation. Demand vanishes, leaving only the sellers. Your action plan: zero leverage. Owanda Japan has already slashed leverage to 5:1. Brokers are scared. If you use margin right now, a single wick down to $70 will send you to the cleaners immediately. Watch those $75, $80 zone. This is the 50% Fibonacci support. If price consolidates here, it's an opportunity to accumulate for the long term. $95 minus $100 zone. This is psychological resistance. If we bounce here, consider taking short-term profits. Do not dream of $150 in February. Mindset: February's for hibernation. Let the market digest the pile of margin call corpses. Don't try to be a hero catching a falling knife. My final question to you. Last Thursday morning, when silver hit $121, what did you do? Did you take profits, or did you buy more out of greed? Be honest with yourself and comment below, because that honesty is the only thing that will stop you from being exit liquidity next time. The bull market isn't dead, but the easy money phase died last Friday. Now it's time for cool heads, and this is the naked truth about the market that CNBC won't tell you. Don't forget to like and subscribe if this video saved your wallet. See you in the next briefing. Look at your portfolio right now. Seriously, open the app. Whether you know it or not, the ground beneath the financial system is shifting, and what is happening to silver right now is about to impact every single dollar you have saved. I'm not talking about some slow-moving trend that will play out over the next decade. I'm talking about a fundamental fracture in the global economy. We just saw gold surge 65% in a single year, the biggest gain since 1979. But while everyone is watching gold, the smart money, I'm talking about the people who actually run the world's financial plumbing, is quietly positioning for something much more explosive. Silver. Here is the terrifying part. While silver is screaming danger, the stock market is partying at all-time highs. Those two things do not happen together unless something is breaking under the surface. The US government is trapping itself in a debt spiral. China is weaponizing its reserves, and the industrial demand for silver is colliding with a currency crisis. By the end of this video, you are going to understand exactly why the US dollar is under attack, why China is hoarding physical metal, and why silver might be the only fire insurance left for your wealth. Let's put this into perspective. For the last 40 years, the playbook was simple. You buy stocks, you buy bonds, and you trust the US dollar. It was boring, it was predictable, and it worked. But looking at the last 12 months, that playbook isn't just broken, it's being incinerated. We are seeing the biggest annual gain in precious metals since the Jimmy Carter era. This is not normal market behavior. This is assets on steroids, chugging energy drinks at 3 a.m. because they know a crash is coming. The mainstream media, CNBC, Bloomberg, they want you to believe this is just about inflation. They tell you silver is up because your groceries cost more. And sure, inflation sucks, but if this was just about inflation, silver and gold would have exploded in 2021 when the Fed printed $4 trillion and inflation hit 9%. They didn't. They went sideways. So why now? Why in late 2025 and entering 2026 is the metal market going parabolic? Because this isn't about the price of goods, it's about the value of the currency itself. The US national debt is now over $38 trillion. We are adding $6 billion in debt every single day. Interest payments on that debt are now over $1 trillion a year, more than the US spends on its entire military. The US government has two choices. Default on the debt, which destroys the economy, or print money to pay it off, which destroys the dollar. They are choosing option 2. And the rest of the world, specifically China, knows it. 1. The silent war, de-dollarization. This is the part the news won't tell you. Foreign countries, the foreign buggers, as we might call them, are quietly losing faith in the US dollar. And when I say quietly, I mean the same way someone quietly deletes their couple photos on Instagram before announcing a divorce. The signs are there, people just pretend not to see them. For 80 years, the dollar was the only game in town. But look at the central banks. 20 years ago, 70% of global reserves were in dollars. Today, it's 58%. That 12% drop represents trillions of dollars being dumped. They aren't just selling dollars. They are diversifying into assets that have no counterparty risk. If you hold a US bond, you are trusting the US government to pay you back in money that is worth something. Right now, nobody trusts that. So they buy gold. But here is where the economic war with China gets interesting. They are looking at silver. To China's strategic stranglehold. China is not just buying gold for its vaults. China is the world's factory. They understand something that Wall Street bankers, who sit in air-conditioned offices moving pixels around on a screen, often forget. You cannot print silver. We are in a technological Cold War. Solar panels, EVs, military-grade electronics, they all require silver. It is the most conductive metal on Earth. You can substitute it easily. While the US plays games with paper derivatives and debt, China is securing physical supply chains. If the US dollar weakens, the cost to import silver into the US skyrockets. If China decides to restrict exports of processed silver or hoard it for their own solar initiatives, the West faces a supply shock that no amount of money printing can fix. This is a squeeze. The West is short on physical reality, and the East is long on hard assets. 3. The island theory of value. Coast. Let me explain why silver prices rising is mathematically guaranteed unless the US changes course, which they won't. Imagine a tropical island with 10 castaways. There are only 10 $1 bills on the entire island. That's the entire money supply. Prices are stable. Now, a guy washes ashore with a suitcase containing $100. Suddenly, the island goes from having $10 to $110, but there are still the same amount of coconuts. What happens? The price of everything must go up. The coconuts didn't get better. The money just became worthless. The US Federal Reserve is that guy washing ashore. Except he's arriving every single day with a new suitcase of cash to pay off the interest on yesterday's debt. In this environment, holding cash is guaranteed poverty. Holding bonds is guaranteed losses. The only way to preserve purchasing power is to hold the asset that the new money cannot dilute. That is why silver isn't just an investment, it is a lifeboat. 4. The market anomaly: stocks versus reality. So, why is the stock market at an all-time high? Why does everything look fine? Because the market is drunk on liquidity. When the government lowers interest rates to make their debt affordable, that money flows into stocks. It creates a wealth illusion. The stock market went up 20%. Great, but the currency you measure it in lost 15% of its purchasing power. You didn't get richer, the numbers just got bigger. Real inflation is found in assets, real estate, stocks, and now precious metals. The difference is, stocks are priced for a perfect future where AI solves everything and earnings grow forever. Silver is priced for the reality, a future of debt debasement, geopolitical conflict, and the end of the dollar's hegemony. One of these markets is wrong. And historically, the bond market and the gold market are the smart money. The stock market is usually the last one to realize the party is over. It's not just governments. Look at the corporate sector. Major industrial giants are starting to realize that just-in-time delivery doesn't work when currency wars break out. We are seeing signs of companies bypassing the futures market, the paper market, and demanding physical delivery of silver. Why? Because they don't trust the paper contracts. If you are a CEO of a solar company, you don't care about the spot price of silver on a computer screen. You care about having the metal in your factory so you can build your product. When trust erodes, premiums on physical metal explode. We are approaching a point where the paper price of silver, manipulated by banks, and the physical price of silver, dictated by real demand, will decouple. And when that snaps, the rally will be violent. So, what does this mean for you? I'm not a financial advisor. I'm just a guy who reads the data that Wall Street tries to bury. But here's the reality. The forces driving this, the $38 trillion debt, the breakdown of US-China relations, the weaponization of currency. These forces aren't going away. If anything, they are accelerating. The US government is trying to pull the wool over your eyes. They want you to focus on the nominal high of your 401 kilobits while they devalue the currency underneath it. It's a magic trick. You need to think of silver and gold not as investments that you flip for a quick buck, but as fire insurance. You don't buy fire insurance because you want your house to burn down. You buy it because if it does, you don't want to be left standing in the ashes with nothing. The central banks are buying insurance. China is buying insurance. The billionaire class is buying insurance. If the smartest money in the world is quietly repositioning out of the dollar and into metal, maybe it's time you asked yourself, why aren't you? If you want to survive the greatest wealth transfer in history, you need to pay attention. Share this video with someone who thinks everything is fine, because everything is not fine. But for those who are prepared, it's the opportunity of a lifetime. Thanks for watching. I'll see you in the next one. 3 weeks ago, on a quiet Friday afternoon in January 2026, while most investors were distracted by the latest AI headlines and retail hype, a massive red flare was shot into the sky from the headquarters of the SEC. It came in the form of a 13 Fahrenheit's filing, a document that most analysts skim and everyone else ignores. But this particular filing contained a revelation that should have stopped the global markets in their tracks. The Bill and Melinda Gates Foundation Trust did not just rebalance its portfolio, it liquidated 2/3 of its Microsoft holdings in a single quarter. 2/3. This wasn't a trim, it was an exit. And as we dug deeper into the filings of dozens of other billionaire-controlled trusts and family offices, a terrifying pattern emerged. A coordinated, silent, and massive withdrawal is taking place. While you are being told that the soft landing is here and the AI revolution is just beginning, the architects of the global economy are dumping their shares at a rate we haven't seen since the eve of the 2008 collapse. We are talking about $89 billion in combined stock sales over the last 6 months alone. This isn't just about stocks. This is about a fundamental shift in the global order. A silent economic war between the US and China over the very resources that make the modern world possible. The smart money isn't just selling. They are retreating into bunkers, railroads, and precious metals. Today, I'm going to show you exactly what they see coming. why the silver squeeze is the real reason tech is dead, and why your retirement account is currently sitting in the middle of a financial minefield. Let's look at the forensic evidence. Between July 1, 2025 and January 15, 2026, corporate insiders across every major sector liquidated approximately $89 billion in publicly traded securities. These aren't theories. These are verified government filings submitted under penalty of perjury. Jeff Bezos, the man who built the everything store, sold $8.5 billion in Amazon stock, 50 million shares, in a mere 9 trading days. Before 2019, Bezos had never sold more than $3 billion in an entire year. This is panic selling disguised as liquidity management. Then we have Mark Zuckerberg, offloading $500 million in Meta. We have Jamie Dimon, the CEO of JP Morgan Chase, selling his own bank stock for the first time in 19 years. Think about that. The man who sits at the center of the American credit system, who sees every default and every loan book, decided that January 2026 was the time to get out. But it's where this money is going that tells the real story. Bill Gates is shifting his foundation's $37 billion portfolio out of the cloud and into the ground. He is buying Waste Management, a trash monopoly. He is buying the Canadian National Railway, irreplaceable physical infrastructure, and he is loading up on Berkshire Hathaway. Why Berkshire? Because Warren Buffett is currently sitting on a record-shattering $325.2 billion in cash and treasury bills. The greatest buy-and-hold investor in history has been a net seller of stocks for 3 consecutive years. He is hoarding cash, waiting for the moment the spring snaps. He's waiting for the crash so he can buy your favorite companies for pennies on the dollar. The message isn't subtle, it's an air raid siren. To understand why the elite are fleeing, you have to look past the paper economy and into the physical one. We are currently witnessing the weaponization of the supply chain in a way the world has never seen, the silver chokehold. For years, the financial media has focused on gold, but the real war is being fought in silver. Silver is the industrial marrow of the 2026 economy. You cannot build an AI server, a 6 GB antenna, or a solar panel without it. China has spent the last decade quietly securing the global silver supply chain, moving from a net exporter to a strategic hoarder, while the US focused on digital assets and software as a service. Beijing focused on the physical elements. By restricting the flow of industrial silver, China is effectively placing a resource embargo on the American tech sector. This is the logical leap the media ignores. If the cost of silver skyrockets due to a supply squeeze, the margins of companies like Apple, Tesla, and Microsoft don't just shrink, they evaporate. This is why the billionaires are selling tech now. They know the AI bubble is about to hit the physical reality wall, the valuation trap. The S&P 500 is currently trading at 22.2 times forward earnings. Historically, there are only 2 times we've seen this level of overvaluation. The dot-com bubble of 2000 and the stimulus bubble of 2021. Both times, the market didn't just correct, it collapsed by 25% to 50%. Furthermore, the AI revolution is showing cracks. Microsoft, Amazon, and Google have collectively spent over $200 billion on AI infrastructure in the past 2 years. Yet the actual revenue from these tools is not yet accretive to earnings. The free cash flow is dropping while the capital expenditure is skyrocketing. The billionaires are selling while the hype keeps valuations elevated, front-running the moment the market realizes the AI ROI is years, if not decades, away. The macro time bomb, the SOM rule. As of today, January 21, 2026, the labor market has officially triggered the SOM rule. Unemployment has ticked up 0.6% from its lows. In the last 50 years, this indicator has a 100% accuracy rate for predicting recessions. But it's not just jobs. Commercial real estate, CRE, is in free fall. Office buildings in major cities are being appraised at 30% to 50% less than their 2019 values. The regional banks holding these loans are walking dead, facing a credit contagion that the billionaires can see coming through their private network of data. They see the consumer breaking under $18 trillion in household debt. They see credit card delinquencies at 15-year highs. They know that when the consumer stops spending, the soft landing narrative will turn into a hard crash overnight. The $89 billion warning is not a suggestion, it is a map of the future. We are entering a period where tangible assets will trump intangible hype. The billionaires are positioning for a world where dividends matter more than growth, and where survival matters more than speculation. Their strategy is crystal clear to anyone paying attention. They are exiting the paper trap by selling tech and financials at record-high valuations while the retail public is still euphoric. Simultaneously, they are hoarding optionality by building massive cash positions to act as dry powder when the forced liquidations begin in the coming months. They are choosing to monopolize essentials, buying the railroads, the waste management systems, and the silver mines, the things people cannot live without, regardless of the GDP. This is the cycle of history repeating itself. We are currently sitting in that dangerous gap between euphoria and panic. The financial media will continue to tell you to stay the course, and your advisor will tell you to diversify into more stocks. But you have to ask yourself a simple question. Do you trust the talking heads on TV who are paid to keep you invested? Or do you trust the actions of the men who actually own the world? They aren't just predicting a crash, they are preparing to profit from it. They are the ones who will be there to save the market by buying your distressed assets for pennies. When the S&P 500 eventually drops 30% or 40% later this year, Warren Buffett will use his $325 billion to buy the world. Bill Gates will own the infrastructure that moves the goods, and the retail investor will be left wondering how they missed the warning signs that were hidden in plain sight. This is how the greatest wealth transfers in history happen, from the emotional to the disciplined, from the late to the early, and from the uninformed to the prepared. The air raid siren has been going off for 6 months. The question isn't whether the crash is coming. The question is, will you be the one holding the bag, or will you follow the smart money out the door while there's still time? The data is public, the pattern is clear, and the billionaires are telling you something through every SEC filing and every liquid cash move. The only question is whether you are listening or if you are waiting for the media to tell you it's okay to panic. By then, it will be too late. The ship has already hit the iceberg. The elite are in the lifeboats. Where are you?
There has been an unwritten rule on Wall Street for the past 40 years. Silence on a Friday evening usually signifies settlement. Positions have been closed, risks have been hedged, and the bankers have left their offices to enjoy the weekend. But this weekend, that silence carries a completely different tone. It is the calm before a Category 5 storm. Last Friday, we witnessed a technical black swan event. According to the standard script, silver prices are always subjected to automated selling pressure during the final session of the week to crush the momentum of the bulls. But this time, that script was torn to shreds. Instead of collapsing, the market accelerated and closed at the absolute highs of the week, $67.14. Let that number sink into your trading psychology, $67.14. For the retail investor, this is good news, but for the risk management departments at the major bullion banks, this is a liquidity disaster. They are currently trapped with billions of dollars in net short positions that are deeply underwater while the market is closed. They are locked in a panic room with no exit for 48 hours. In today's deep dive report, we are going to dissect this event. We will analyze why this closing price is not just a number, but the fuse that will trigger a massive chain of margin calls come Monday morning. To understand the severity of this, we need to look at the market microstructure. When a market closes at the highs of the week, it sends an incredibly powerful signal. The buyers accepted market orders at any price, right down to the final seconds. This indicates that smart money currently fears the risk of not owning the asset more than they fear the price risk itself. Put yourself in the shoes of a market maker who is short silver in the $64 region. Their quantitative models predicted a drop to $60 so they could cover and take profit. But reality forced the price to $67.14. Their unrealized loss is currently sitting at over $3 per ounce on a volume of millions of ounces. But we must also address the elephant in the room, the options market and gamma exposure. At $67.14, we have pushed deep in the money, ITM, for a vast array of call options that were previously written off as worthless. This forces options dealers into a gamma squeeze. As the price rises, dealers, who must remain market neutral, are mathematically forced to buy more of the underlying futures to hedge their exposure. It becomes a feedback loop from hell for the shorts. They aren't just fighting the trend, they are fighting the mathematics of the derivatives market itself. Furthermore, we must anticipate the reaction of high-frequency trading algorithms. These black boxes thrive on momentum ignition. A gap opening above $67.14 will trigger automated buy programs before a single human trader has had their morning coffee. These algorithms do not care about valuation, they only care about velocity. They will pour fuel on the fire, exacerbating the move in milliseconds. And here is the fatal issue: variation margin. Typically, these losses are settled in cash at the end of the day, but Friday's price shock was too massive and too fast. It blew through the credit lines of many hedge funds. On Saturday morning, while the market was closed, margin calls were sent out. The demand is simple: post additional collateral before the Asian Open on Monday or face forced liquidation. And when a short fund faces forced liquidation, the computer system executes only one command: buy back at any price to close the position. This creates a classic short squeeze scenario. On Monday morning, we may not see buying power from natural demand, but buying power born from the panic of financial institutions trampling over each other to exit.
However, the financial story is just the tip of the iceberg. The submerged part, and the most dangerous part, lies in the dislocation between the paper market and the physical market. We are witnessing a record-breaking arbitrage spread. In New York, COMEX, silver is at $67.14, but in Shanghai, SGE, silver is trading around the $72 mark. A $5 spread in the commodities market is a massive figure. It creates a vacuum effect. Any silver bar that can be moved is being packed and shipped from London and New York to China. The West is suffering a physical liquidity drain. Why? Because industrial giants like Samsung or Tesla cannot operate production lines using futures contracts. They need real metal. They are executing off-market deals, securing supply directly from the mines, bypassing the COMEX entirely. Furthermore, we are hearing reports of a quiet run on the bank regarding unallocated accounts. For years, banks have sold paper claims on silver they do not fully possess, a fractional reserve system. But now, high-net-worth clients and family offices are demanding conversion to allocated status. They are asking for the serial numbers. They want the bars moved to a segregated shelf. This forces the banks to show their hand. If they don't have the metal, they must go into the open market and buy it immediately to satisfy the client and prevent a default event. This internal squeeze is invisible to the public, but it is the primary driver of the desperation we are seeing. The consequence? The spot price on your screen is slowly becoming a virtual reference. It no longer reflects the true cost to possess the physical metal. Registered inventory, metal that meets delivery standards, is depleting at an alarming rate. We are approaching 0 hour. When the Asian markets open, the most probable scenario is a gap up. The price could open directly at $68.50 or $69, skipping the intermediate levels entirely. However, as professional investors, we must keep a cool head. Extreme volatility always comes with risk. Here is the battle plan for the upcoming session: patience in the face of a gap up. If the market opens with a massive gap to the upside, do not FOMO. In theory, the price often tends to return to fill the gap, to test demand. Watch the support zone at $67. Beware the shakeout. Understand that the institutions know the retail psychology. They may engineer a sharp, violent drop, a rug pull in the early hours to trigger stop losses and flush out weak hands. Do not mistake a liquidity flush for a trend reversal. Monitor the psychological level of $70. This is not just a round number, it is the last bastion of the bears. If the price decisively breaks $70, the technical model shifts to a parabolic state, vertical appreciation into the price discovery zone. Focus on real assets. In an environment of elevated counterparty risk, holding physical positions is the optimal defensive measure. In conclusion, Friday's closing price of $67.14 is not the destination. It is the siren signaling the collapse of the old price control algorithms. The bank's liquidity nightmare is becoming a historic opportunity for investors who are prepared. I will continue to update you on capital flow developments as soon as the session begins. Thank you for watching.